I'm just befuddled. I mean, I don't think Jerome Powell's nefarious by nature, but he's got to be aware that the policies enacted after COVID, which was $6 trillion of deficit spending, $5 trillion of debt monetization by the Federal Reserve, by expanding its balance sheet in that short duration of time. That has eviscerated most of the middle class. So it's not the rate of change of inflation that he should be cheering. Okay, so it was 9% according to official statistics, and now it's 3% or 2.5%. Core rate is 3.2, headlines 2.5. Big deal. It's the level of prices that is the problem for most Americans. So if you look at average hourly wages, they're up about 22% over the past 4.5 years, and CPI is up about 22% over the last 4.5 years. Well, congratulations, there isn't a problem. That you say, okay, but wait a second. If you use the CPI, it's not such a big deal. But if you look at things like the home prices that are up over 50%, insurance costs 50%, food costs over 30%, car prices up over 40%. So in reality, inflation's up about 50% and their wages are up 22%. And that's average wages. It's not the median wage. So it's skewed towards the top end because the top 10% or 1%, the top 20% of the population is doing pretty good. You know, their stocks are up and their houses are up and they're feeling pretty good. But most people have been, if you're a renter or if you don't have a decent job, you're just struggling to survive every day. I'm befuddled because I don't understand why he's declaring victory over inflation. He should be saying what consumers really need is deflation to bring prices back in line, asset bubbles back in line with reality, or to a price that can be supported by the free market. And he's not doing that. He's declaring victory. So he cut by 50 basis points, but does that fix everything that's wrong with the world? And you listen to Wall Street, you think, oh, the Fed's got our back. The last few times the Fed cut by 50 basis points didn't work out so well. So they cut rates in 2020 because of COVID very quickly in a few months down to zero. But S&P still lost 35% of its value. And in 2007, they cut rates in the summer by 50 basis points because they realized there might be a problem, even though it was contained, and then we weren't in a recession. The Fed had our back, and the Fed put was back in place in the summer of 2007, but the stock market still went down by 50%, the S&P, in the ensuing couple of years. But just because the Fed is cutting interest rates doesn't, it's not a panacea. It doesn't ameliorate all of our problems. We still have massive asset bubbles in the real estate market, in the equity market, and in the credit markets. That didn't go away. As a matter of fact, they could be getting much worse because of what he's doing. I don't think what he's doing is good enough. I think it's too little, too late. Apparently, we still have quantitative tightening going on, right? I mean, the Fed's balance sheet is still shrinking. The Fed's not adding liquidity. The Chinese are adding a lot of liquidity, but that's renminbi. It's not a fully convertible currency. So it's not clear to me how that immediately turns around the liquidity issue that we have. The reverse repo facility is almost completely dry. Listen, we have some pretty worrying trends like the unemployment rate and delinquencies. And defaults are all rising. Those tend to be secular trends when they begin. They don't stop because the Fed cut by 50 basis points. And here's the one other thing I want to mention. The time that the Fed is cutting now happens to be the first time in history we have a problem with inflation and we have an insolvent government. And the Fed's rate cuts were well telegraphed. So the longer duration bonds already priced in. The bond market has already priced in the Fed's rate cuts. When the Fed started cutting rates, the 10-year note was 3.6%. Normally, the 10-year note is about 5% plus. In other words, what I'm trying to say is that the Fed is cutting rates to get interest rates to fall, but they already fell, and now they're rising because the Jerome Powell thinks fight with inflation's over. So everything that he's supposed to be doing to make the economy better is the exact opposite. So rates are rising. So mortgage rates will rise, and then costs to issue debt will rise, and that's going to go against everything he's trying to do. We're not in the clear just because the Fed cut rates by 50 basis points, even though I think he's an absolute moron for doing it. So the secular trend of the economy is for nominal interest rates to be lowered. And the Fed understands that the government can't pay $1 trillion in interest in debt. So they're going to have to get short-term and long-term rates lower. So if nominal rates are down, they do that by printing money. And that means real interest rates rise. So gold could be in a secular bull market that's just beginning. I don't care if it's overbought. I don't care if it pulls back 10% or 15%. But I'm looking at long-term secular trends, and the trend is much higher in my opinion. It's because of lower nominal and real interest rates. That's the only thing gold is really concerned about. Of course, World War III doesn't hurt it either. And God forbid that happens, but you do have a lot of geopolitical conflagrations going around. Not only Ukraine, you have the Middle East. So that does tend to help the price of gold, but that's just a very temporary blip. So we're looking at the dollar price of gold, the U.S. is becoming insolvent. Debt and deficits are out of control. The Fed can't raise interest rates to fight inflation. They panic to lower interest rates. That's less competition for gold, which pays no interest, and it pushes more people into that hedge. I'm not net short the market right now. I don't even have any shorts at all except for a very tiny short in high yield. It's my only short that I have. But I'm long India, working out well. I'm long gold. I actually bought some silver recently. I own utilities. We own all kinds of things here because it's not time yet. My model is built, my inflation, deflation, economic cycle model is a timing tool. But just because it hasn't triggered me to get net short the market doesn't mean that I'll never have to get there. Because like you said, these problems are extant. They're only getting worse. The debt continues to pile up. Corporations are issuing more and more debt. If you look at total non-financial debt to GDP, it's at a record high. The government is insolvent, 720% debt to revenue as far as the Treasury is concerned. Our deficits are $2 trillion per annum in supposedly good times, in times of full employment. There's huge problems. They haven't come to the surface yet, but they're festering underneath. And when they come to the surface, it's going to be a huge, huge problem. I believe in mathematics and genuine economics, and I believe in reality. And the reality is that home prices are about 40% higher than what they need to be affordable to the average American. Home price to income ratios are just that much out of whack. And the same is true for the stock market. It's about 50% overvalued if you look at the total market cap of equities as a percentage of the economy. So these things tend to mean revert. If you believe in mean reversion, then they're going to happen. It's taking longer than even I would have thought, but who cares? There's just so much liquidity out there, and the Fed and other governments keep trying to delay the inevitable. But you can't delay the inevitable. Let's just take an example. Let's look at Japan. Japan has quadrillion yen in debt outstanding, and if the bond market in Japan, JGBs, was reliant on tax revenue to finance the debt, their interest rates would be double digits. However, that can't happen in Japan because the Bank of Japan raised interest rates to 0.5%, and it caused a chaos in the global markets because it was an unwind of the yen carry trade and markets were flushed down the toilet. The Bank of Japan can't even raise interest rates to 0.25% to 0.5%. That's because the Bank of Japan owns almost all of the government bonds. So this is what we're heading into. So in reality, the 10-year note has no darn business trading at 3.7% or 3.8%. Not with inflation just ending 9% and insolvent government and $2 trillion deficits. No way. So without the Fed's balance sheet being, now $7 trillion, and without the Fed's put out there, interest rates would be much higher, which would bankrupt the country because we have so much debt. So the Fed has to print money, but if the Fed prints money, you get inflation, and that means bond yields have to rise. So it's catch-22. And that's what happened. This is not a new phenomenon. This is what happened in every country that has went bankrupt in the past, which you print money to make the debt solvent, which causes inflation, which causes interest rates to rise. So you have to print more money, causes hyperinflation, and you destroy the economy. That's where we're headed, unfortunately. When I was a kid, I first got in this business in 1991. I never thought we would let this happen. We were supposed to be a country that tied our monetary policy to gold. That was destroyed completely in 1971. I remember how terrible the 70s were because of gas lines and everything. My father had to get up at like 4 o'clock in the morning to sit on a gas line to get an odd and even license plate number to get gas. But inflation has destroyed every fiat currency throughout history. And unfortunately, the United States is traveling that same road because the Fed's balance sheet, which is called high-powered money, was zero before 1913. But from 1913 all the way to 2007, it took them all those years to print $800 billion. And from 2007 to 2022, that $800 billion went to $9 trillion of high-powered money, which is physical currency and coins in circulation plus Fed credit, which is the building blocks of all money. It goes into the banks, and the banks use those reserves to create loans and to buy bonds and to expand the money supply. And unfortunately, I think it's going to happen again. And imagine if the Fed's balance sheet goes to $20 trillion, $30 trillion, and you don't want to own gold. I'll just say, if Bitcoin can go to $63,000 a unit, then why can't gold go to a few $1,000s an ounce? Because, gold, AU, comes from exploding stars, and it's an element in the Earth's crust. It's very limited, and you can't create any more of it. And it's virtually indestructible, and it's extremely rare. However, cryptocurrencies are based on blockchains, where this digital ledger or a coin can ride along. So they're not unique. I don't care if there's 21 million units of Bitcoin, because thousands of cryptocurrencies that trade that do pretty much the same thing. So go buy yourself some gold. I'm just saying that if you believe, like I believe, that real interest rates are falling and nominal rates will be capped because the government is insolvent and they can't afford to pay interest on the debt, which is why Mr. Powell lowered interest rates in the first place, then you need to buy gold. Fortunately, I don't have to predict going out months and months and quarters and years. I don't do that. So the model is updated every day, and I'm going to stick to my model. Right now, the model says that economic growth is going to slow, and there's no reason for me to believe that economic growth is going to surge. It's just not going to happen. There's not going to be a huge reflation of growth. So I'm looking into the middle of 2025. There could be a fiscal cliff coming. So if we have a divided government, and that means it's going to be very difficult to extend the Trump tax cuts, which were instrumental in causing inflation and growth to jump in his first term. So if that's the case, then I believe we're going to have huge problems heading into the later half of 2025 and 2026. Could be very bad. But that's just a prediction, and I'm not trading on it. I don't trade on what's going to happen next year. What's happening now is you have slow, anemic growth, but not a recession. We have a lot of problems in the economy. The allocation is for bond and bond proxies, which have worked very well. We have some physical gold and physical silver. We have India in the portfolio. We have the utilities in the portfolio. So we have no shorts except for a small short in high yield. We're going to hold that. And when things change, I change. But the model is a predictive model. So it predicts when things are going to change. And right now, it doesn't tell me I need to get all panicky about the stock market. So I'm not going to do it. And when people call me a perma bear, what they think they're referring to is that I'm a perma bear on the fundamentals of the U.S. economy. And it's not just the U.S. economy. It's almost all developed economies in the world. I don't like economies that are fake, artificial. I think economies should be market-based, based on what the people want. That's the beauty of America. It's a free market economy. Not that it's perfect, but it's based on the millions of people voting every day with what they want and having companies respond to that need. That's no longer the case here. We have an artificial economy. We have an economy that is controlled by fiscal and monetary madness. So that's what I'm bearish on. But if I was bearish on the stock market all the time, I wouldn't have a business, a thriving business, thank God. But I do. And the reason why I have that is because I understand when it's time to go short the market. You go short during recessions and deflations and liquidity crises. And what you go long matters. So that's what I do.